Everybody, welcome back to Dividend Stockpile. I'm excited to welcome Hans Williams, Head of ETF Distribution at Calamos Investments, to talk about their brand new fund, the Calamos Autocallable Income ETF, CAIE. This innovative ETF takes a unique approach to generating income by using structured products with an autocallable feature, blending the potential for attractive yields with risk management strategies. So we're going to dive into how CAIE works, what makes it different from other income-focused ETFs, and how it might fit into your portfolio as a dividend and income investor. So with that, Hans, welcome to the show.
Thanks, Jeremy. I appreciate you having me on.
I know a couple of people from the community have asked me to do a video on this product, so I figured instead of me just going through the product, I want to get someone from the company on to talk through it, so I'm glad you're able to make it happen. So before we get started, can you give a little bit of your background, what you do at Calamos, and what Calamos is all about?
Yeah, happy to. So I joined the industry about 13 years ago, more on the capital market side of the equation, with a company called Guggenheim Investments back when they had ETFs. And over the last 13 years, I've been at a number of different firms, but I've always spent, I've always been on the ETF side of the equation. So it's been really interesting for me to witness the proliferation of the different types of ETF strategies that have come out over that 13-year period. What's been obvious is the acceleration of that, certainly over the last 5 years, with derivative income ETFs bringing new markets to the ETF wrapper. And my role at Calamos is to head up our ETF distribution efforts and being involved with product development as well. And based on my background, what we've brought to market this year is really the fusion of the structured note space, which has been around for almost 20 years now, primarily accessed through institutions. And so we've married that space with the ETF wrapper as a first to market firm. So we are intimately involved in expanding that space here at Calamos. The adoption's been obvious, so we're keenly focused on that at this point in time.
So this is called an autocallable income ETF.
That's right.
So that's kind of a new term for a lot of individual investors. So can you kind of explain at a high level what an autocallable is? And we'll dig into the details later.
Yeah, I like to think about it this way. If you're familiar with, say, high yield corporate bonds, which a lot of people are obviously, and a lot of firms use high yield corporates within, whether it's a mutual fund wrapper or ETF wrapper inside your conventional fixed sleeve portfolios. High yield corporate bonds often have what's called a call feature, meaning, for instance, if you issue a 5-year bond, if you're a company, and after a few years, there's the availability to call it away if interest rates decrease, and you would call it away to potentially refinance at a lower interest rate, as long as that bond is trading trading above 102. And once it's entered its call period, it's trading above 102, that company has the ability to call it away. It's gone. It never reaches maturity. Investor gets back the call price on that bond. An autocallable works like this. One, it's important to know that unlike a conventional bond, where that's inversely related to interest rates, so if rates come down, its price goes up, think about an autocallable note not tied to interest rates in terms of movement, or I should say inversely related to interest rates in terms of its movement, its price movement. But you could say structure it in a way where it's say chained to an equity index or multiple equity indexes. And we'll stay with one index just because that's how we've structured our ETF. But staying on the individual structured note example, you could have one structured note tied to a single underlier. And that underlier could be, for example, the S&P 500, or it could be Euro stocks or the Russell 2, et cetera. Let's say it's tied to the S&P 500. So the client would go to a bank, and it's typically bespoke, meaning you customize it with what you want. So let's say you want a 5-year structured note tied to the S&P 500 as the underlier, and let's say it has a 1-year non-call period. So in that first year, it'll make all its coupon payments, assuming it's above what's called the coupon barrier, which oftentimes is, let's say it's 40% below par. And they're usually issued at slight discounts to par, kind of like sometimes a bond can be issued, or I should say in the case of like a treasury bill. But once that note begins trading, as long as it's above that coupon barrier, it'll make all of its coupon payments in that first year, which oftentimes are monthly installments. And its price movement in the market is not a function of interest rates. It's a function of how did the S&P perform that day. So if it's issued at, say, 96 cents on the dollar, and the S&P goes up 1%, it could be up around 1%, maybe a little more depending on its volatility management. But typically it's gonna move with the S&P 500. And so that's very different than an individual bond, which has your conventional duration, credit quality that could influence that movement. So think of it like a bond that moves like the S&P 500 in this example. Now, once you're past that 1-year non-call period, if the S&P performance is positive, it's simply auto called at what's called a monthly observation date. There's usually one observation date each month. So when you get to that, when you're a year plus a week, and you're in that eligible call period, that auto callable is simply called away. It's gone. The investor gets back par on that note. And then as the investor, if you want to buy another note, you've got to go shop around again. There's paperwork involved. It's somewhat of an arduous process. 96% of the time, an auto callable is called away between months 12 and 18 of its life. Very, very rarely a 5-year auto callable actually makes its way to the end. And then rinse and repeat, you go buy a new 5-year auto callable. So that's essentially how an auto callable note works.
Okay. And so for this particular ETF, you guys accumulate a series of these auto callable notes into their portfolio. So you have them expiring at different times during the cycle.
The ETF itself is a laddered portfolio of 5-year term auto callables.
Okay.
So that's the index that is replicated via the ETF. So if you were to look at our site, we actually transparently show you, we mark to market this on a daily basis. We show you every single one of the auto callables inside of it. And every Friday, a new 5-year auto callable is actually added to the index and begins its life. So it begins that journey of 12 months of not eligible to be called away. And then again, once it's past its 12 months, you can actually see, you can hover over one of the dots, one of the auto callable dots, and see if it's been around for at least a year, where its price is in the market, and if it's trading above par at its next observation date, which again, one observation date monthly, it's simply removed from the index. But we've solved for that problem from the sense of, by adding a new 5-year term auto callable every Friday. Oftentimes one's going to be removed on a Friday, but on that same Friday, a new 5 years added.
Now, what happens if one of those calls or one of those notes goes under the 40% drawdown that you guys set up? What happens at that point?
Yeah, it's an important point to bring up. So they're all 5-year term auto callables in this portfolio. They're all issued at a very slight discount to par, typically 96 cents or so on the dollar. So the 40% barrier, think of that kind of like, as long as that auto callable is above 60 cents on the dollar, it'll make its monthly coupon payment. Okay. But let's say remember, they're tied to the S&P 500 in the case of CAIE. So if the S&P 500 drops 35-40% and that auto callable drops below 60 cents, and then it reaches its observation date that month and it's trading at 58 cents on the dollar, it will not make a coupon payment for that month, for that single auto callable. And that's the case of a single auto callable within CAIE. It's the case of a single auto callable note that you might buy instead for a client. But that's how auto callables work. And that's why we like the diversification enhancement of it, because if it's one or two that aren't making that monthly coupon out of 60, at least you're still getting a bulk of that 14% annualized coupon. But to answer your question, if it drops below and reaches the observation date, there's no coupon for that month.
Yeah, and that's one of the benefits of having them at different expiration time periods is that, to your point, if the S&P 500 is down 40% on one or two of those contracts, those are going to stop. But the rest of the 58 or whatever number you have is still going to continue to make that payment. And if the market goes back up before the next one hits that callable time period, then that one's not affected because it's gone back up.
Yeah, now keep in mind as well, like that's really important as well. Let's say so what are we talking about here? What's the biggest risk with CAIE or a structured note in general? Auto callable. It's left tail equity risk. It's 2008 happens. It's a deep drawdown that takes a few quarters to recover.
Yeah.
Even during COVID, for example, we modeled it out. Deep drawdown, but a quick recovery. They all would have actually been trading above 60 cents on the dollar during an episode like that. But what you're trading is you're taking on left tail equity risk for a high stable coupon is the way to think about it. And then on top of that, remember each auto callable is tied to the S&P 500. So if you get a 40% drawdown, but 25% of the way through that drawdown, we got to a Friday and a new auto callable was issued at 96 cents on the dollar. It's not as though every single auto callable is going to be below, right? It's when was the auto callable issued and when was it issued in relation to the market movement. So it's really important to keep in mind, and it's why on our website every single day we show an updated the updated portfolio of the index that we're replicating to show every single auto callable and its relation relative to the barriers, the coupon barrier on the downside, and something we haven't gotten into because it rarely happens in auto callable world, but we've also matched the coupon barrier with the maturity barrier.
Okay. Meaning,
let's say in the very rare case, an auto callable actually makes it almost the full 5 years. It's not auto call. For that to happen, the equity market would have to trade sideways and be slightly lower, right? Let's say it's a month away, the market drops 50%. And that auto callable is trading at 55 cents on the dollar and reaches maturity. Maturity barrier at 60 means that that auto callable now finishes at 55 cents on the dollar for that one auto callable, whether it's in our ETF or you own it individually as an auto callable note on the side. You get back 55 cents on the dollar on that. It's major principal impairment. If it's trading at 61 cents at maturity, you get back par.
Yeah.
So that's true of a single auto callable note that you own or an auto callable, the experience of it inside CAIE's portfolio.
Okay. So for an individual investor, maybe on a more layman's term, you guys are collecting a monthly interest payment or a monthly payment from each of these auto callables, and that's what you distribute. We take on the risk of it going below a 40% drawdown in the S&P 500 during that cycle for that individual auto callable. But is there any kind of upside to these products that an investor can have beyond the income that comes in?
With the way we've designed CAIE, I like to think of it like a bond.
Okay.
So a bond with a strict call provision. If you were to look at our site, you would see right now that the weighted average mark to market is something like 99.8. It's essentially at par.
Okay.
So there is the other risk, not really a risk, but an important feature is there is negative convexity for sure with CAIE's portfolio and with any auto callable yield note that you buy, meaning as it draws closer and closer to its call eligible period, it's probably not going to trade much above 103, maybe 104.
Got it.
Because of the likelihood of it being called away. So the gravity that is negative convexity in terms of preventing a auto callable's price from moving higher becomes very real and more intensified as you draw closer to probability of that autocallable being called away. So it essentially pushes it down to par because of how that works operationally. So then convert that to how the ETF's net asset value is going to trade. So if you were to pull up its NAV right now or its market price, I think it's around 27.30.
Okay.
And remember, its average price right now is essentially par. So could the ETF move another 3 or 4% higher above 27.30? That's possible, but that's essentially the ceiling on it right now at this point in time. So the total return experience, the best way to think about it at this point in time is the total return is basically 100% the income. However, whether or not you own CAIE, let's say you do get a 20% market drawdown, and that weighted average mark to market is no longer at par. Let's say it's at 80 cents on the dollar. We'll take 80% of where CAIE is trading right now. That moves it down to say 23, maybe 22.50, right? Somewhere around there. So if you were an investor at that point in time, now you do have some appreciation potential because of the way that, again, like a bond that maybe trades to 80 cents on the dollar. Think about a high yield bond back in 2008 that made it and was trading at 60 cents on the dollar. You realized a pretty healthy coupon on it, and you got that bond to go from 60 up to par over the remaining years of its life, if it did materialize and mature at par. So it really depends on your cost with CAIE when you bought it, and the upside potential related to its CAIE's mark to market when you bought it, and then how the S&P performs over the next few years. So if you're bullish on the S&P and the market drops 15%, and you think there's going to be a relatively quick recovery, or just a recovery in general over the next few years, it's a great opportunity to add CAIE, but also understand you're getting around a 14% coupon right now, and some pretty realistic expectation of the net asset value moving higher, assuming that market correction does manifest itself.
Yeah, gotcha. And the biggest risk is if it's a prolonged downturn in the S&P 500, more than 40%, that's when it starts affecting the income that comes in. But otherwise, if you hold on to it as each one gets called away or matures, as long as the S&P 500 is, over that 40%, you'll more than likely make your principal back. But then you've been getting that income every month while you've been holding it.
Yep, the accretion is a very real thing at that point in time in that example. You'd want to check what is the market discount at this point in time. Do I think the equity markets are going to recover, specifically the S&P 500, because that's the single underlier with every single one of our autocallables inside CAIE. And then from there, do I like the coupon? What is the coupon? And then you can start to figure out your sort of like your best case scenario price upside along with the coupon you're going to be clipping as you go from month to month.
Okay, awesome. So just to kind of summarize, it's a monthly distribution. Right now it's around that 14% yield. If the S&P 500 does not see a prolonged 40% drawdown, the principal is relatively stable.
You'd see the net asset value kind of trade sideways.
Okay, perfect. So just at a high level, I know there's a lot of places this could fit, but what does Calamos think that this is like? What's the ideal audience for this particular product? Where does it fit in someone's portfolio?
The early adopters out of the gate with this. So CAIE's been around for about 3 months now. We're at about 270 million in assets. The early adopters that have showed up have actually been the structured note users that have looked at this like, I can use this alongside structured notes that I own, specifically autocallables, or I like that I don't have to go shopping for single autocallables again. I can just hit the easy button and go buy CAIE, and I get the autocallable experience, right? Secondly, we have advisors and firms telling us they're using this inside fixed income sleeves, specifically as either high yield replacements or alongside high yield exposure. You're going to get about a 1.1 to 1.15 beta on CAIE relative to the S&P. So, we've had advisors tell us that given that little extra bit of volatility to them, they've slotted CAIE inside their high yield fixed income sleeves. And then thirdly, any advisor that, whether it's like a model that's full of derivative income ETFs, so option premium income ETFs, buy right ETFs, anything derivative income related, we've seen them slot CAIE in there as well. So And then actually, fourthly, we're starting to see firms, because of the S&P 500 tie, use this a lot as like a bolt-on to SPY. So you actually, because of the fact that the underlier is the S&P 500, you are essentially getting, it's very interesting. It's S&P 500 like total return experience over a market cycle.
Yep.
You're basically converting price upside in the form of present day cash flow because of that coupon rate. So it's one of those four main ways that we're seeing advisors out of the gates use CAIE throughout portfolios.
Yeah, I like it. I like the fourth one because a lot of people are invested in things like the S&P 500, but the yield for an income investor is so low. I think it hit the record low, like 1.1%. So if you're an income investor, but you still want exposure to SPY, adding something like CAIE to your portfolio gives you that immediate income, but still ties you to the S&P 500. So that's a very interesting approach that you could take. So it looks like this can fit in a lot of people's different portfolios, different need structure. So it's great to have a product that can fit so many different aspects of an investor's profile. So where can people find more information about CAIE?
If you go to our website, you can easily find CAIE. If you hover over the ETF section, if you go to Google and you type in CAIE ETF, it's one of the first ones to pop up, and then find the link that goes to the CAIE fund page on our site. And if you scroll down a bit, I think the most valuable thing to find, and I've mentioned this a few times, is what's called the CAIE dashboard. It shows you every single auto-callable and its relationship relative to its coupon barrier, its call barrier. All the information you need is right there at that CAIE dashboard if you scroll down a bit on our fund profile page. So that's probably the best place to go.
Okay, awesome. It's great that ETF providers like Calamos provide such education and information out to their investors so they really know what's going on, and you can look for yourself to see if it's the right move for you. All right, so Hans, really appreciate all your information about CAIE. For everyone, is CAIE, the Calamos Autocallable Income ETF. Really appreciate your time, and hopefully we'll be able to talk soon, Hans. Thanks.
Yes. Likewise. Thanks, Jeremy.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.